Inflation Wars Global Edition. Inflation has been pretty much a one-way battle, or I guess a two-item battle here. Of course, I'm biased living in the U.S., but the main headlines have been U.S. inflation being kind of a benchmark for how the global economy has been doing, and then U.S. interest rates. We've been at the forefront of hiking interest rates to combat inflation. And so the story, by and large, until recently, has been, okay, how is U.S. inflation doing? And then how are the U.S. central bankers looking to combat that inflation? That's been the main story. Getting a little bit murkier, but with that murkiness comes more opportunities in the different markets that are moving around as inflation headlines start to soar in other places around the world. And U.S. inflation, though we had a higher number than expected today, is on the general downtrend. Just to further illuminate this first piece before bringing in other regions' inflation, the battle, for the most part, of course, I'm oversimplifying here, but the battle for the most part is inflation higher. There's more money flying around. Stuff is getting more expensive. We're worried about that, whatever region is witnessing that inflation. And so what are we going to do? Well, let's raise interest rates. Let's contract that economy. Let's make it less easy to get that money and throw it around. And thus, stuff can't continue to get more expensive because the consumers, it's, hey, man, it's harder for me to get these dollars to pay for your expensive goods. So you better bring those prices down. And so as we saw inflation rise through the latter part of 2021 and the first part of 2022 there, the Fed came out and hiked interest rates north of 4%. And that has had the effect that you'd hope for, right? Inflation now trending lower. It's not as low as most people would like. They usually target about a 2% inflation number. We're still triple that, but at least on that downtrend. Now, what's been interesting is on the uptrend, you could see a really high correlation between the different asset classes of our economy playing out. Now on the downtrend, and as inflation starts to rise in other places like the UK, those correlations breaking up a little bit. And I have what I think is a really, really well-situated chart here to show you exactly that. You'll notice that here in black, you've got the 2-year interest rate, short-term interest rate benchmark there, and the Fed, remember, moves around short-term interest rates. And then in red, you have the U.S. currency, U.S. dollar. And the story, as inflation was on the rise in the U.S., was inflation higher, rates higher, U.S. dollar higher. And you'll notice, where do these things diverge? Where do rates stay high? And now the last couple of days, especially edge even higher, getting back to the highs for the last several years, potentially breaking them. We'll see what happens in the next couple of days because they're right back at those highs. U.S. dollars back to the middle of the range. What spurred on this divergence starting around September, October of 2022? Well, it just so happens that that's around the same time where we started to trend lower in U.S. inflation. And I'm going to bring in another piece that's really going to solidify this. So what's happening? Well, right around, we're going to stick to that September, October point in time. We're seeing inflation start to trend lower in the U.S. We're seeing U.S. dollars start to trend lower a little bit, but interest rates stay where they have been hiked to by the Fed and potentially getting a little bit higher. What has changed? Well, this is the piece that's really going to solidify why currencies have broken away from that one-for-one correlation with interest rates. UK inflation, for example, one of the major pairs against the US dollar, the British pound, they're actually peaking as we speak in terms of inflation. And so this is one of those things where inflation is high in the US, so maybe you should get a stronger interest rate and a potentially stronger currency there. But hey, man, you guys are so last year UK inflation, that's where it's really popping off. They're above 10% there, and they've got an inflation number in the next 24 hours. They're expected to quote above 10% again. And if they surprise from 10% to 11% or something like that, then you better believe that the Bank of England is going to be caused to hike rates even further. And that could bring even further strength into that British pound and further devaluation into the US dollar. I know that I'm talking about a lot of different ties here throughout our economy and the foreign exchange space, but keep in mind, again, that the way that these things have been trending for the last several months is high inflation, high rates, high currency. But now that the inflation is not only high in the US, and of course it was trending upward. You can see from February until June and July, it was trending upward in the UK, but it's staying high in the UK. And so now the idea becomes, well, the US currently has a higher interest rate than they do in the UK. But if the US inflation is starting to trend lower and UK inflation is staying bid and maybe is even getting higher, then the Bank of England might overtake the US in interest rates. And the last time the Bank of England had higher interest rates than the US was about a year ago. It was last April, actually. They were 25 basis points higher than we were. And at that time, the British pound was higher than where it is now. And so you see these things start to kind of move in tandem. And we'll get to stocks here in a second, how that piece of the puzzle also fits. But inflation is moving interest rates, which moves FX. And keep in mind that if inflation is high throughout most of the major global economies, then it's going to become a game of, well, everybody has high inflation, everybody has higher interest rates than they did a year ago, but who has the highest interest rates? And right now, it is still, out of the major economies, it is still the US, and that's why we have still a relatively strong currency basis a year or two ago. But if this trend of, lower and lower inflation in the US continues and higher inflation in the UK continues, and this differential of interest rates that I have in front of you here gets back to zero or even negative, then that British pound might get back to its prior glory of not $1.25 where it's trading around now, but $1.30, $1.40. Those have been relatively normal prices the last 5 to 10 years. And so, again, a lot of gears moving in these different asset classes, but hopefully it playing out in your minds that inflation moving higher is moving interest rates higher. And now the FX piece, it used to be pretty much one for one. We go back to this chart here. It was relatively speaking, I mean, look at that 2-year yield and the US dollar rates moving higher across not only the US, but the globe for the first part of 2022, almost one for one reflects in strength in the US dollar. But now, as those non-US central banks get higher and higher in their interest rates, if they get to the US or surpass them, this US dollar could continue to move lower. That's where the correlation starts to break away, and why we look at these interest rate differentials, because it's no longer one for one that, inflation is high here in the US. Well, I'm going to buy dollars because those dollars should move higher as inflation moves higher. No, if the UK has higher inflation and they have to hike their interest rates higher than we have them, then people are going to be selling their dollars, buying British pounds to get those higher interest rates. And you can see here, again, the differentials between those US and UK interest rates. We peaked in September, which, again, keep that time period in your mind, because that was, guess what, the peak in US dollars right there, that same time period as the peak in terms of US UK rate differerentials. Now, the flip side of this, as we get into how inflation and interest rate differentials move these foreign exchange currencies, the flip side of it is if U.S. inflation goes from, it got all the way up to 9%, now it's down to 6%, but we had a surprise higher than expected here today. We get back to 8, 9, 10%. And if the Fed has to not only top out around 5% interest rates, but they need to get up to 6% or 7% interest rates, then you could see a resurgence in this US dollar, and you could see the pound and the euro fall back down closer to parity, and that yen fall back down to its lows. But if inflation does continue to come off in the US and it stays high in the Eurozone and UK and Japan, and they have to hike rates to where we're at or even higher, then you could see this previous normalcy of the pound at 135, where it was a little over a year ago. And of course, traders of FX from way back will remember, like, man, the pound's been as high as $2 to 1. So plenty of ground in either direction there. Again, there's your interest rate differentials. It's peaked at 150 basis points. The U.S. was on top of the Bank of England, now down to under 1% or 100 basis points at 80 basis points. Now we'll see where they go in the next couple of months.